Good afternoon, this is Mike Bartleson, the Bear Market Investor. The market update for January 10, 2012. We're here looking at the S&P 500 stock index in the daily time frame. We're also going to be looking at the intraday time frames as well. Now, let me give you a little bit of background on myself first here before I get into some of the other topics that I wanted to discuss. First, I'm a market technician that specializes in a form and a very widely accepted form of technical analysis called Elliott Wave. Elliott Wave is something that is modeled under waves of pessimism and optimism, meaning it's very similar to traditional behavioral finance in that when markets are very optimistic, it is more likely a top is being put in. When they are very pessimistic, it is more likely that a bottom is being put in. And that is, forms essentially patterns that have rules which guide the formation of them and what we expect to see based on what has occurred in the past. So it allows us to find a potential reversal of trend. It attempts, or it shows us when to potentially expect corrections to occur, and it shows us how those corrections might occur. It doesn't necessarily mean that Elliotticians have to agree on everything. That is because people have different opinions. As long as you're following the rules, you can have legitimate differences of opinion. And many Elliotticians happen to agree and disagree on different points. And I happen to be one of the Elliotticians, one of the market technicians that practices Elliott Wave, that believes that we are in a much larger bear market. Whether or not that bear market began back in the turn of the century, or began in 2007, or perhaps a little bit of both, depending on the indice that you're looking at. I believe that we're in a much larger bear market, and that bear market has further to run here, meaning probably in the years. From a cyclical standpoint, I do believe that we're probably looking in that at least late 2014, 2015 into 2016 timeframe before we're likely to see a bottom in some markets occur. I think the overall cyclical bottom is probably more likely in that 2016 range, but some indexes, commodities, whatever, can bottom early, and I think we have to just analyze each of them individually on their own merit and see exactly what that wave structure is. Now, I happen to concentrate mostly on the S&P 500. It's not to say that personally I don't follow other markets. I do follow precious metals. I follow other things. I happen to make videos occasionally on silver, for example. I did make one last video. I think I touched on silver, suggesting that we could have a very interesting market here in precious metals. But I wanted to say that I really didn't have a very strong opinion on whether the top was in with regard to precious metals or not. I do believe in deflation. I believe that deflation, which is just simply the way of the free market correcting its imbalances, particularly its excesses, is likely to occur here. And I think we're going to have a very, very large deflationary environment that's likely to occur over a period of years here, perhaps into that 2016 area, before finally seeing a large bottom here in the market. And I do believe that the market is likely to experience a very, very deep sell-off, meaning probably the largest one this generation has ever seen. And if you understand how to play that and keep yourself, agile and understanding exactly how the market is likely to unfold, you're likely to be able to take advantage of those buying opportunities when we do finally reach a bottom in the markets. Stocks will be cheap at that point, just as they were in March of 2009, things of that nature. So from a larger perspective, that's That's the goal, is to identify what the trend is and not fight the trend. To be able to invest in the trend and identify when that trend is likely to come to an end. So, without further ado, let's go ahead and go into wave structure. Now, many Elliottians or market technicians that practice Elliott Wave have, I believe, erroneously identified the top in the S&P 500 from an Elliott Wave perspective to be this point right here. Now, it's not to say that they are wrong, but I happen to believe that they probably are wrong, and that the top was actually put in at this point. And I've, discussed why this is in prior videos. To some extent, it's an academic argument at best. I don't think it necessarily alters any wave structure here to any great degree. So I'm not going to put a whole lot of emphasis on that. Whether or not you believe it happened here or here is somewhat irrelevant to the larger wave structure. But what I was saying was, after we had started to see this very dramatic sell-off occur, that we had eventually gotten to a point where there were very few options from a larger Elliott Wave perspective with regard to how to view this entire decline, and that I believe this was the conclusion at this point of an ABC rally from the March 2009 lows, and that we are resuming the larger bear market, which means the market will continue down and most likely past the March 2009 lows, and probably very, very quickly. Okay, that's something to note, and I think it's a very important thing to note as well. And that either we're proceeding down in a larger C wave, or proceeding down in a larger third wave, and that we are going to be in either a third of a third wave or a third of C wave, depending on how you look at it. I'm not going to sit there and argue one way or another right now, because I don't think it's entirely important at this point in time. It will become eventually, but that argument can be saved for another day. So let's have a look at our wave structure. What we have here is a first wave down, a second wave up, a third wave down, a fourth wave up in the form of a complex double zigzag correction, then a fifth wave down in the form of an ending diagonal. Now, the ending diagonal, I can say, at that point in time was a really difficult call, primarily because I wasn't entirely certain that we had ended with a double zigzag and that we weren't working a triple zigzag, or that we didn't have a truncation in a triple zigzag, because really this structure here, while it fits and doesn't break any rules with regard to an ending diagonal, it doesn't fit the textbook example of one in the way that it formed. Meaning, typically with an ending diagonal, you have a first wave that is the longest, then you have a third wave which is slightly shorter than the first wave, and then you have a fifth wave which is slightly shorter than the third wave. Now, a third wave can never, ever, ever in Elliott Wave be the shortest wave. If it is, you are counting it wrong. There is no way to count any type of wave structure with a third wave being the shortest wave. It is a rules violation. Don't do it, because you will likely come up with a count that eventually becomes obviously invalid. And it won't help your trading out if you're anticipating something that has in fact violated rules. So that said, this was a very ugly example of an ending diagonal. At this point in time, I believe this was about when I did my last video here. Ever since then, I'd been commenting on the YouTube channel with regard to my thoughts on what the market was doing. And I had said basically that we should expect a very sharp rally that will catch a lot of bears off guard. Okay? And it's pretty plain to see that that was in fact the case. I didn't realize just how sharp this would be. I thought it would be, pretty dramatic, but this was just downright surprising to me. I think it did catch a lot of bears short, and essentially a giant short squeeze all the way up to that peak right there. And then we did have a pretty dramatic sell-off, got some of the bears revved up again. I certainly remember that. And then we continued up again. Now, after this peak had been put in here, many Elliotticians were calling this the peak of intermediate wave 2. I didn't think that that was probably the case, even though I accepted the fact that it could be. It just didn't seem right to me that this would be correcting, or in this period of time would be correcting all of this or all of this, depending on which way you look at it. It was just simply too short. So what I really thought was more likely to occur was some sort of complex correction or a continuation of the correction in any case. I'm counting this really as a B, C, then an X wave, which is a three-wave pattern basically, or a three-wave connector, followed by an A, B, and then a C, which we're working on terminating at this point right here. And that really had been my stance for quite a while, that this really was just simply too sharp and too fast to really have been, I think, the completion of intermediate wave 2. I mean, realistically, yes, if we had continued down, I would just have to have accepted the fact that that was, in fact, the peak of intermediate wave 2. But as I've shown, that it actually was not. Now, as far as support and resistance are concerned, going all the way back to the 2000 peak in the S&P 500 stock index, we have a couple trend lines I want to show you here. First is this area right here of support and resistance. We can see clearly that the market actually, did regard those as areas of support and resistance, testing them and retesting them time and time again. Same thing with this right here, depending on whether or not you looked at it in logarithmic or arithmetic scaling. Okay, very, very important thing to note. Now, one thing that we also identified is that if you take this peak back here in late 2010 and connect that with this and this low right here, you actually have a very nice neckline style formation here, area of resistance in the market that we're bumping into essentially right at this very moment. In fact, as you'll see in the intraday time frame, we're right there, man. We are right dead on that, and we did push ever so slightly through it before coming back down. Now, areas of support and resistance are meant to be broken. They're meant to be fractured. I mean, this goes all the way back to the 2000 peak in the S&P 500, has acted as a long-term area of support and resistance, and you can clearly see that it did keep the market from moving above it, a number of times. But the market eventually did, find its way to push up, further into that area above this lower trend line right here, before only coming back down again, coming back up, coming back down, testing it again, coming back to test it again, coming back to test it again, coming back to test it again, so on and so forth. So, we're right up in this area right here where we would expect a top to be put in. Now, back in the comments that I was leaving the YouTube channel section, or comment section, I had mentioned that I really believe that we're probably going to see a top from a cyclical standpoint put in at this point right here, and this is where I was expecting it to be put in. It still is from a standpoint of price, okay, and we have ever so slightly pushed into that zone. But I wanted to leave that there because I had said essentially that I believe that this area right here was going to be a cyclical peak, and it did turn out to be a cyclical peak, but that it was going to probably be the termination point for intermediate wave 2. But that wasn't the case. In fact, we did continue on, and I still continue to be an advocate for the continuation of intermediate wave 2, and that we would eventually and likely take out this peak right here. And we have just done that. We have today taken out that peak right there. We have satisfied the minimum requirements and expectations for a double zigzag pattern. Now, it isn't necessarily to say, of course, that this is where we will end, but we are likely to end somewhere below, this point right here, and this is in that 1330 range. I put a stop in at 1330 right now, but based on the Elliott Wave structure that you're going to see in the intraday time frame, I have pretty good reason to believe that we are just about complete with this, if not already. But I do think there's probably more likely a little bit more upside, a little penetration we're probably going to see tomorrow or sometime very soon this week, similar to what we saw back here, of that trend line to push us ever so slightly higher, maybe up to the top of a trend line that I'll show you in just a moment here in the intraday time frame. So anyway, that's what we got here. Ultimately, as soon as we see this breakdown here, that's going to be a pretty strong indication that we have seen the top. And particularly if we break below this low, if you're a very conservative investor in any trend, and you're looking for more of a confirmation that in fact we have reversed, I would probably be looking for a takeout of this area right here if you want to be really conservative. Certainly a break of this, which would of course occur if we were to take out this low right here. So that would be a very conservative stance to take if you're looking to short the market, but weren't really wanting to be as aggressive as I am right now. And that I just today began taking out a leverage short position in the S&P 500 stock index, as I said I would do. I just had been out of the market for a very, very long period of time here, not participating in this because I believed that we would see the market at least hold up, if not move higher than this peak eventually, and that's exactly what we have here. So next day or so, I think we'll see a peak. Now let's go ahead and jump into the intraday time frame. Actually, first, let me show you the indicators here. Certainly, we do have potential divergence here in the MACD histogram in the daily time frame. Hard to say divergence here in the RSI, but we're not seeing exactly some major amount of strength like we were seeing back at earlier points here, suggesting that we are in fact going to have higher highs in the near future, or that the market is going to power ahead. I think we're seeing that the market is beginning to fracture here from a momentum perspective, from a strength perspective. And MACD histogram seeing the same thing there, lower peaks in the histogram towers there. So let's go ahead and have a look in the intraday time frame. Okay, we're looking at the hourly time frame, the S&P 500 stock index, specifically at the second zigzag of the double zigzag correction of intermediate wave 2. To give you a frame of reference, this is the 3-wave connector, or X wave, connecting the zigzags of the double zigzag correction of intermediate wave 2. From there we had the wave A up, wave B down, and we are currently working on terminating the wave C up. We formed a nice little channel right here, and although we've run into resistance, I do suspect still, even though I am already short the S&P 500 at 1295 and change, that we may see a little bit of additional upside yet. Now, this wave structure within wave C, I have to admit, is very, very difficult to get a read on, but I can say that when I'm not sure exactly how to count something, I try to look for something familiar. I try to look for something that will tell me where we likely are within the wave structure. Now, there is a possibility, one way or another, that we are in some sort of ending diagonal. That would mean perhaps wave 1 terminated here. We have wave 2, we have a wave 3, we have a wave 4, and we're currently working wave 5 right there. There's another way of counting it that has us in some sort of fourth wave triangle there. There's another way of counting that says we have fourth wave terminating at this point right here. Unfortunately, because of the fact that there are varying ways of counting it, it does make a little bit of a difference in saying whether or not we've already topped or whether we're just about to top. But regardless, it doesn't make any real or substantive difference uh, in the bigger picture. Meaning, I'm still projecting that regardless of how you count this wave C right here, that we are just about ready to top here. Now, the reason I began shorting at slightly above this level at the 1295 and change was because we slammed right into that resistance right there. We met a number of criteria for this intermediate wave 2 to be over. We got into the price range that I was expecting that we would get into. Now, granted, we're on the lower side of it, but because of the fact we're channeling right here at the moment, because of the fact this is looking relatively weak, and we're seeing divergence already occurring here within the MACD, histogram, etc. We're not seeing a huge amount of strength within the RSI. The ADX is not yet showing any real conviction with regard to the trend. I mean, positive DI is making a lower tower there. There are a number of Fibonacci relationships. There's wave relationships within this, that lead me to believe that we're really darn close to this top occurring right here. And as far as the upper boundary of this channel, say we were to do that tomorrow, right away even, we're looking maybe, into that 307 area, maybe if we were to last a little bit later into the 310, or if we were to exceed the upper boundary of that upper channel line, which is sometimes possible in an overthrow scenario. Those types of things are acceptable risk to me to the upside. Moreover, we have declining areas of resistance here in and around that 1330 area, which is why I placed my stop in and around that point. I may actually end up lowering that. I may stop myself out. I may raise it. It depends. I just want to have a stop in place right now. And I'm okay with having a little bit of a loose stop there, saying that I'm allowing the thing to get up to 1330 right now, just to cover myself, just in case. You never really want to enter into any type of position without having a stop in place. It could even just be something as simple as I get hit by a bus tomorrow, I'm in a hospital, and the market just decides it's going to go crazy and go up by another 100 points in the S&P. I want to be taken out of that position, particularly if I know that's going to substantively alter the overall wave structure that I'm my eye on at the moment. And that is very, very important, meaning intermediate wave 2 has to top below where intermediate wave 1 began. Now that's in that 1350s area. If you were to actually consider the peak in the S&P 500, you're looking at the 1370s area, okay, from a price standpoint. But I just don't think that's very likely, all right? So, again, I think we're really, really close to this peak here, and I'm going to show you in the 5-minute chart here in just a moment. Now, with regard to the time and price that I originally laid out there for the peaking of intermediate wave 2 in the S&P 500, I'd established this right here. As you can see, we actually had a really nice channel going right into that area. Now, it did turn out to be, as I noted, a cyclical high, but it didn't turn out to be the high of intermediate wave 2. A little bit of a bummer. I was kind of putting two and two together. Had some other types of relationships that I was looking at with regard to particularly this first week in December or so, that we would actually see a high put in place for intermediate wave 2. And that's why I really had my eye on this decline right here. Because some Elliotticians had said, and I didn't think this was probably the case, but I was, never 100% sure. Some Elliotticians had said this was actually a 5-wave decline. Now, in order to count it as such, you would have to have a very poorly defined 5th wave, which sometimes does occur, almost everything occurring almost more in a wedge form than anything. I just didn't think that was likely. This looked like a simple X-wave connection of a double zigzag pattern, or at least just a 3-wave correction, in that we would see a C wave up. And so it was perfectly reasonable for me to then say, since we did have a cyclical top in that point, that it is possible that we were about to enter into a very steep decline. However, because we did not do that, because the Elliotticians then would say that this had to have been a third wave, this should have been a very, very steep and sharp decline, not overlapping garbage like we were getting right here. That led me to believe that was a correction rather than impulsive. And so that's why I was expecting and more solidified on the idea that we were in fact still in intermediate wave 2. So that is where we are at the moment. Let's go ahead and have a look at the 5-minute chart and get a read in on this. Here we're looking at the S&P 500 stock index in the 5-minute time frame. What I want to do is throw out a possible very short-term wave structure count within the S&P 500, which may yet lead us slightly higher than we are right now. And this is how that would look. As I noted, there was a potential that we had a contracting triangle terminate at this point, probably a fourth wave. From there, then we can assume that this is all part of a larger fifth wave. Now, whether or not we terminated that already remains to be seen, but here's probably the way that looks. And that is, we actually had the first of fifth terminating here. We had a second of fifth. We had a first of third of fifth, second of third, third of third, fourth of third, fifth of third. We had that fourth of fifth terminating at this point. So that would make this the first of fifth, second of fifth, and that means that we could very well expect a strong opening tomorrow morning in a third of fifth. Now, I would generally expect that a third of third is going to be stronger than a third of fifth. And I think that's probably going to be the case here. But remember, third waves just cannot be the shortest wave, okay? But they don't necessarily have to be the longest. Usually they are pretty powerful, though. So as far as, normal expectations, I would say that it's probably pretty well likely that we're going to see a strong opening tomorrow. It may not be quite as strong as we saw there. We'll see some still divergence occurring here with even the 5-minute chart. The RSI obviously showing divergence there. We're not showing a particularly strong indication here within the ADX and the 5-minute chart, so relatively trendless right now. Certainly tomorrow it's going to perk up one way or another. Now again, I cannot rule out the possibility that we did in fact top, which is of course why I was taking out a short position at this level, especially with what I feel to be pretty strong resistance here and here. It's reasonable for me to take out a short position in that we probably will see relatively minimal risk to the upside at this point. But that isn't necessarily to say that we couldn't see, another, well, I guess from 1291, another 30 points to the upside, maybe even more. But I don't think that's likely. I think it's most likely that it will terminate below 1320, probably below 1310. Let's wait and see. Have a great night. Please rate the video if you would. I apologize I hadn't had a chance to make a video for a long time. Hope you enjoyed it. I will see you guys later.